You think you know what's happening in the United States real estate market? Think again. We got people saying we're headed for a crash. We got people saying the market is booming. But what's really happening with prices, inventory, and where the trend is going? We have a new administration right now, and there's global events that could affect the market. The next few minutes could reshape your real estate strategy. Let's go over it. All right, for those who don't know me, my name is James Santiago, and I'm a Houston, Texas real estate agent. And I'm also a landlord here. I invest in properties in Houston, Texas. And basically, I'm your host in this show, Learn Wealthy. And today we're going to talk about the US real estate market. And as you know, real estate is a hyper local asset. That means whatever's happening in San Francisco or San Diego is going to be different from what's going on somewhere else, like Denver, Colorado, because every sub market is going to have a totally different economy, totally different jobs, set of people that's affecting the value of the real estate in that area. You know, location, location, location. So today, we're going to talk about the United States real estate as a whole, plus we're going to talk about the sub-markets too. We're going to talk about the inventory, prices, the trend on where things are going. And then we're going to talk about the policies of where this new administration can take the real estate market. And as you know, global events, if you're studying macroeconomics, you know that the ledgers of each countries and central banks are very interconnected, and also the trades are very interconnected. And basically what happens with global events can affect the real estate market too in the United States, even though assets are hyper local. It's still important to get a bird's eye view of the real estate market, because even if it's hyper local, sometimes a global macroeconomic event like what happened with 2008 can affect every single local market. So let's go over it. All right, so let's start with the days on market and levels of inventory. So we're talking about nationwide right now. So inventory is up 19% year over year. This is one factor that we could be headed to a buyer's market, but we have to look at other data. So the current market supply is 4.2 months. 4.2, I would say that's a balanced market. If you got 6 months of market supply and over, I would say that's definitely a buyer's market. And if you got 2 months or less, that would be a seller's market. So, but homes are definitely staying longer, average of 60 days compared to 45 days last year. So the slowing down of sales average as a nationwide is definitely having an impact in the favor of buyers. So sellers might need to be patient, and sellers might need to readjust their prices. So let's talk about home prices and buyer strength. So the median home price in October is $407,200. This is national. It's still an all-time high in spite of the slowing down of transactions. So price growth is slowing, even though it's still at an all-time high. The buyers definitely have been facing affordability challenges with the prices being at an all-time high. If you look at this chart of Case-Shiller index adjusted to inflation, you can see that the prices is an all-time high adjusted to inflation. Also, we had these recent crazy inflations the past couple years, where the wages haven't kept up. And also, we still have high mortgage rates, even though the Fed cut rates twice recently, and all your real estate agents and mortgage brokers are saying, oh, mortgage rates are going to go down because the Fed cut rates. But if you really study macroeconomics, you'll know that the 30-year mortgages really follow the 10-year treasury. So basically, I'm saying buyers are down and tapped out. And you can see that with the amount of transaction happening right now compared to the amount of transactions happening the past few years. The number of transactions right now is really down. And that's not just because the supply is low, but also the buyers are tapped out. Not just the first-time home buyers, but also the investors. Let's go over the 30-year mortgage. Right now, it's about 7.12% on average nationwide. And that is pretty high. Not that high. It's about a little bit above average historically. But if you combine that with the all-time high prices of real estate, because if you look at this Case-Shiller index, the price of real estate is at an all-time high adjusted for inflation. So if you combine that, not crazy high mortgage, 7.12%, plus the all-time high prices of real estate, and then then buyers are really going to tap out. So what I do here at Learn Wealthy is I used to have Monday market updates, but now I'm only probably going to make one video every week. just so I'm not forced to just kind of talk here and there's nothing really going on. I really want to use your time wisely as my audience. Then, so I want to make sure that whenever I put out a video, that I'm not just gonna put out a video just for the sake of putting out a video. I want to make sure that it's packed with news and details. So yeah, I'm not gonna do that Monday market update anymore, and whenever I put out a video every week, I want to make sure it has substance. So, yep, the mortgage rate is 7.12%. So in this Learn Wealthy show, we're gonna watch the 10-year Treasury, and we're gonna update you as needed if it changes or not. Most likely, where this 10-year Treasury is going, the 30-year mortgage rate will follow, because historically they kind of mirror each other if you look at this chart. All right, we're gonna talk about a few major cities and their movement and how this is affecting the real estate market as a whole. So we're gonna talk about cities with a rising inventory. We have Tampa, and I still have a home there. And as you know, they've been devastated by the hurricanes back to back, and the insurance cost is rising. So this is one of the major contributors. I'm sure there's other factors like economically, but this is one of the major contributors why the inventory in Tampa is rising a lot. There's also Phoenix inventory is rising, Dallas inventory is rising. You know, people have moved into Texas, like I have moved from California to Houston last year. A lot of people moved into Dallas and Austin and all the other, and also in Florida. And a lot of employers have been realizing that letting people work from home is not that efficient, you know? People are always more efficient when they're actually at work with their boss and without all the distractions of being at home. So a lot of these companies are actually asking people to come back and not work from home anymore. So I think that's a contributing factor of why the Dallas, even in Tampa, Phoenix, and Denver, even that's why their inventory levels are rising right now. But there's also cities with constrained inventory like Chicago, Cleveland, Boston, where prices are rising faster because there's not enough real estate and there's heavy amount of population in these cities. All right, as you know, we have the new Trump administration coming in. So I don't think they're going to affect the real estate market, at least not right away. You know, they have to get in position, they have to pass laws, and those laws have to be practiced and take effect into the economy. So I don't think we'll be seeing any results of whatever the Trump administration will bring until maybe 2026. They have proposed tax cuts, though, which could boost people's ability to buy real estate. You know, at the end of the day, real estate is a people business. If your tenants don't have any money, if your tenants are broke and they can't afford rent anymore, then as a landlord, you're not going to have any business. And even if you're in a real estate sales department, you know, if you don't have any buyers, if you don't have any sellers, because the economy is not well, then you're not gonna have any sales. So for the most part, your landlord, at least the good ones, wants you to be better off and wants you to have a good job and a comfortable life so you can be a paying tenant. Even though I know how they always illustrate landlords as a bad guy in the mainstream media. And then there's this concern about national debt, which I just made a video about. We're now at 36 trillion. So you can watch this video right here. I think I did great at that video. This national debt just keeps increasing. So that's going to affect the value of real estate. There's no direct correlation of the national debt and the rate of inflation historically, but in the long run, I believe the national debt will cause a long-term inflation. So in the long run, even though we're going to have a Doge department that's supposed to bring logic into our budgeting, because, you know, no politician ever cares about budgets, you know. They always spend more than what they make in tax revenues. If this Doge, like Elon Musk and Vivek, is going to be successful at actually budgeting and decreasing national debt, but even if they are the next administrations going to continue to do that and be responsible and spend less than what we make as a country? You know, I don't think so. So I think eventually we're still headed for that asset prices just going up and up and up and up and up. Even though we go through business cycles, I believe asset prices are just going to keep going up and up and up and up and up. I don't know. Who knows until when? You know, infinity is really a number that we don't know until when infinity can end. That's why it's called infinity. Also, the China commercial real estate market is pretty bad right now. So even that can send shockwaves all over the world. Just like how we we had a 2008 real estate crash, and we actually sent recession all over the world because all these commercial bank ledgers all over the world are interconnected, and all these economies are highly dependent with each other because our banking system and our trades are highly globalized. So closing takeaways for buyers, we have the rising inventory, rising days on market. Even though the prices are still at an all-time high, the movement of real estate is really slow. Like when you say real estate crash, like real estate doesn't really crash. It's just a slow, painful grind. It's either grinding up or grinding down. Like when we had the 2007 recession, the house prices didn't hit rock bottom till 2012. So how many years is that? 2008, 9, 10, 11, 12. So that's a long time for the house prices to grind down slowly. So if house prices do go down, I don't think it's gonna happen like how it does in stocks or Bitcoin, how it goes up like that and Wile E. Coyote drop. If we do have a real estate crash is what they say, even though I don't think it really crashes, it's gonna be a slow, painful grind down. But it will introduce opportunities for those people who will see opportunities. But it's not always easy to see opportunities where you're in that moment. But back in 2008 to 2010, like people don't want to touch real estate because the prices kept going down. So people think, oh, it's a toxic asset. We want to stay away from that. The prices are just going to keep going down. But really, that's a great time to buy, But people, you wouldn't really usually see it at that time when you're in that moment. That's why you have to stay calm as an investor, kind of look at fundamentals and how people are seeing things and how you're seeing things and compare it. And today I'm not using a teleprompter, and I want to be more real, and I've been practicing public speaking. I want this channel to feel like I'm talking with you and not I'm talking at you, I want it to feel like I'm just in a room with you like a friend. I want to hear your opinion on how that's working out, so please comment down below. So for more finance, investing, real estate, and macroeconomics, let's all learn wealthy together. I'll see you in the next video.